So today I'm going to share with you a very simple yet effective strategy that you could apply to your trading to become a more successful trader. Now, if you are an experienced trader or just someone that's brand new into the market, and if you want a system that really would gain you confidence in trading and gain you experience to, put more experienced trades into your trading portfolio, this is a strategy that could help you get started. Now, don't get fooled by just me calling it very simple and basic, because this strategy would help you gain a very high probability of success as well. And this is what you could backtest this back to the day just to prove my point and what I mean it being so successful and being so good to trade with. So without all further ado, let's get started and see exactly what you need to be successful in this trading strategy. Now, a few things that you need to really get this strategy down to pat is you need to know your trading style. Now, what I mean by trading style is, are you a long-term trader or a short-term trader? Now, the way you would come to know that for your personal trading experience journey is how much time can you spend trading? Can you spend an hour a day? Can you spend an hour a week? Or can you spend an hour a month? Now, if you cannot spend a lot of time trading, then a long-term approach would be a better suit for you. So that's something to keep in mind while you decide on what is your preferred strategy. Now, the second is your trading time frame. Now, you could trade any different time frames as you like, but if you're a novice trader, if you're new to trading, I would highly recommend sticking to the weekly time frames. And the reason for that is you do have more time. You have a week before the candle would form, and you would have a chance to make a decision on what you should do next. So you're not rushing into the trades, and you would have less chances of making an error in judgment. So that's my recommended time frame, but you could go to the daily, you could go down to the 4 hours as well, but that's just my preferred approach to be a more successful trader. Now, with that, the third thing you need to keep in mind is your favorite stock, index, or ETF. Now, depending on the country you are trading in, you may or may not have an index or an ETF that you could trade with. Now, you could also use futures as well, depending on what your trading style is, but this is just like some common basic things that you would need to get into your arsenal to start trading the strategy. So the first is looking at a stock. Now, you could even look at say an Apple or a Google or any stock that is available in your company. Just pick one that has a higher volume so that you could apply it into your trading. Now, there are a few other things you would have to keep in mind, and I will share with you once we look at some charts. Now, the fourth thing and the only technical thing that you would need in this particular strategy is the 200 SMA, 50 EMA, and the 20 EMA. Now, the 200 SMA, which is the 200 simple moving average, the reason I've picked that one is that's the most common simple moving average that a lot of professional traders use. And that's the reason why I'm trying to incorporate it into the strategy as well. Now, the second is the 50 EMA and the 20 EMA. Now, that's just common terms. You can mix it up, use the 40 EMA or even choose your personal preference. But these are just like what the professionals use, and you'll see a lot of changes in direction when these particular moving averages are hit, and I'll explain what that means soon as well. So with that, keep all of these 4 points in mind while we decide on what is your preferred approach to trading, and let's look at some charts so that it gives you a better perspective of what this would mean for you. So now that we've got the basics right, let's look at an example and see how this would be applied to our daily trading strategy. So the first thing you need to keep in mind is the stock. Now, you could use any stock. This is just an example of the S&P 500 that I have in front of me, and I'm looking at the S&P 500 index on the weekly time frame. Now, the weekly time frame I said was a preferred approach. If you're a beginner, if you need more time to really decide on your trades, this is the best strategy that could actually help you become successful and also gain confidence in your trading. So all the things that we need in this is these 3 moving average, and that's the only technical indicators we would use in our trading strategy. So the first technical indicator is the 200 SMA. Now, in my example here, I have kept it on the 200 EMA, but that's just my preference. You could use either or. There is no hard and fast rule on both of these. The second is the 50 EMA, and that's the purple line that you see on your screen. and the third is the 20 EMA. So these are the three lines. It is applicable to every trading software that you have. So if you are with a brokerage firm as well, just add these three moving average lines and you should be good to get this started with. Now, once we've got these three moving averages in, the only thing you need to do is to make sure that these two lines, that's the 20 period moving average line and the purple line, which is the 50 period moving average line, are fanned out from each other. Another good principle to keep in mind is make sure that these lines are at a fair distance from each other. So the yellow, the purple, and the blue are at fanned out, or it's at a fair distance from each other. So now that's taken care of. What that actually means is that the market is trending, and that's just the way that these moving averages separate out to show that to you. So now that we've actually made sure that this is a trending market and these three lines are fanned out, the next thing I will do is to make sure that I buy close to my yellow line. Now, what I'm talking to you about is the short-term trading strategy approach. Now, in the short-term trading strategy approach, I will buy close to but above the yellow moving average line. So what I mean by that is that I would probably buy around the 3018 mark, and I'm going to let it be active until it crosses the line again. Now, another rule of thumb to keep in mind is to make sure that you could either sell it as soon as it crosses below and ends at the end below the yellow line. That's one way you could get rid of the stock. Or the second way you could do it is make sure that if the next candle is below and starts below and heads lower, that's when you can end your trade. So there's two approaches that you could do. You could buy above but close to the yellow moving average line and sell if it touches it again, and that's one way you could sell it. The second way you could also sell it is that as soon as it moves away from the moving average line, so that's like a rubber band. So think about it like a dog, like the dog's on the leash, and every time the dog goes away, far away, you just pull it back. And that's what happens to these stock prices. So the dog's moving away and then it whacks it back again to the moving average line. The dog again moves away and again it whacks it back again to the moving average line. So it does happen. Sometimes you get a lot more leeway before it comes back, but it will eventually come back. So that's just the principle behind it. So the short-term trading strategy is you buy over the yellow line, and it should be close to the yellow line, and you sell far away, or you sell when it touches the moving average line again. So that's again a short-term strategy. When I say short-term, it's still a few months apart before you would actually close your trade. Now this is just because I'm looking at the weekly time frame, and if you look at the daily time frame, you would have maybe a few days before you can actually buy and sell as well. So that's again a strategy that you could apply based on what is your appetite of trading on a daily or a weekly basis. So that's the short-term strategy. So I buy, I maybe like wait, sell it off here when it's far away, and it's just like, you abandoning your dog. That's something that you could think about. Or you could wait for it to come back and just respect the leash line and then again let it go back out far out again as well. So that's just one strategy. You'll see that in that particular trading approach, so I would buy again here and sell it out at this line. So I've made a good chunk of profit all the way back to the yellow line. Again, I bought it from here as soon as it went above it, and I sold it as soon as it came back there. So again, I made some profit. I could have either sold it here, I could sold it here. So that's short-term trading strategy on a weekly time frame, looking at the yellow moving average line. Now the second one, and this is a little longer term, but what this long term would do is that it would help you get less choppiness. As you can see, there was one choppiness here where I could have probably made some more money. There's another choppiness here where if I sold this and I actually it was kind of going below the yellow line, I panicked out and I sold it, I could have lost some money. So the second strategy, which is a fairly longer term strategy, is looking at the purple line. And now this is a weekly time frame, so the weekly time frame has a greater chance of success compared to the daily, and that's why I'm focusing so much on the weekly. So the second time frame is focusing on the purple line. Now the strategy for that is again the same, where the yellow, the purple, and the blue should be spread apart. They should not be close to each other. They should be spread apart. and you buy very close to above the purple line. So don't buy all the way there, don't buy all the way there, buy close to the purple line. So the strategy goes as the same. So you'll buy it somewhere around here. So this is 29th of June 2020, but you will only sell it if it touches the purple line again. Now you could always sell it far away from the line. Again, you're giving the dog a bigger leash, and you're asking the dog to, okay, you can go around, but don't go too far. And if it goes too far, you could just like let it go, or you could then wait for it to come back and then like, scold it and be like, why did you not listen to me? So it's up to you. But if I was to buy there, so I bought it around, say June 2020. And if I was to follow that strategy, I would have sold or got rid of my stock, any particular stock that it was in February 2022. So I have held the stock for almost 2 years, but my gains have almost tripled, and it would be so much more that I would get in comparison to the shorter moving average. So that's the difference between the two. And let's look at another example to see how this would make more sense. So this is just another example. I have Tesla on the weekly time frame. Now Tesla is an electrical company that manufactures amazing cars. So just so that you have another perspective of a stock. Now you could pick any stock that you have a favorite, but just make sure that these categories are met while you're deciding these stocks. So again, what I would do in my short-term trading strategy, I'm just going to zoom in so you see this better, is I would look for the 3 moving average lines, the yellow, the purple. Now these are just my favorite colors. You could pick your favorite colors while you like decide these moving average lines. So you make sure that these 3 lines are fanned out, and you would buy close to above the yellow moving average line. So the price should be above the moving average line. So that's around here. So I bought it around here, and this is around 122, and this was on April 20th. I would then hold Tesla until it breaks down below the 20 period moving average line, and that's when it broke it around 650. So imagine from 100 to 650, you made 6 times the profit, and it's never touched it ever, in that span of time. So another thing to keep in mind is also what does the particular stock that you're looking at actually like respect the moving average line. So I'm just thinking, what exactly was that word? But it means respect. So sometimes a stock would respect the 50 moving average line on particular stocks on different time frames. So keep that in mind while you're looking at it. So the way you would figure that out is look back in time and see, if you go back a few years, when was the last time the stock bounced out of like a particular moving average line? So did it bounce out of the purple, or did it bounce out of the yellow? So that'll give you a good indicator of what lines or what moving averages does these stocks respect. So I would have bought Tesla somewhere around the top here, and I would have sold it around here as soon as it touches that line. So I've made 6 times my profit, and I would be good. Now, some of the other investors would probably sell at the peaks. Some would sell around here, some would sell around here, some would sell around here. But I personally feel that strategy, though it may give you the best rewards because you're actually selling it at the topmost, you can't really figure out, or you would never know, is this the top or is this the top? So you might actually leave more on the table trying to pick the tops or the bottoms in some cases as well. So my recommended approach is to wait until it actually crosses the moving average line. So see, it crossed the line here, and that would probably be my sell. So in this case, now that's a short-term strategy on the weekly time frame. Now, if you were the more long-term approach where you're ready to just buy and keep it for a few months, no, years in fact, then the purple line would come into the picture, and that's the long-term strategy that I was talking to you about. Now, you could buy your, and you could just keep holding. And if you look, so even though there was a decline, some of the traders may be like, oh, I just can't wait for like 4 months that my stock is just sitting idle and not making me money. I just want to get rid of it. Because from like February or March of 2021 until the August of 2021, it didn't really do anything. So you might have instances where the stock is still idle, but it's still above the 50 period moving average line. So that's something to keep in mind. What is your goal, or are you looking extra long term, or are you looking medium term? So some people will look for a hybrid between the two as well, like, depending on your trading strategy. But if you were to stick to the ultra long term, which is the purple line, buying it just above the purple line and then selling it when it goes below the purple line and closes below the purple line, so you would have held it all the way until your, and maybe around somewhere you would have got rid of it. But see, Tesla's still holding strong on the 50 period moving average line, which is a good sign. So that's just like a simple take on how you could apply this to your day-to-day trading. Do go back, look at your favorite charts as well, and see if this makes sense to you. See if this would still be applicable to you. And do write down in your comments on what your thoughts are on this particular trading strategy approach. Does it fit your needs? Does it actually give you a new revelation that, oh my gosh, I wish I knew this before? Let me know your thoughts on this. And also, we could try applying this to more stocks in the future and see how this could actually help you become more successful and give you confidence in placing your trades as well. So with that, I hope you enjoyed this small video. I hope you got some benefit out of this strategy, and you could try it out and see if it really makes sense. Maybe paper trade it as well and see if this is a good strategy for you. So with that, thank you, and I hope to see you in another video. If you do like this video, do raise a thumbs up for me. It'll help me gain more views in this process as well. So thank you, and see you very soon.